So, you know that in project finance, you need to sculpt debt. Sounds like quite a fancy term, doesn't it? What does it mean, and how do we actually do this? Hi, I'm Kyle, and welcome to Finmodo. You're here because you want to learn concepts in project finance and financial modeling, and you want them explained quickly and easily. In terms of learning objectives, you'll learn a few different debt repayment types. You'll understand why in project finance we sculpt debt, and then you'll get an insider's view on how to calculate sculpted debt repayments in Excel. So where does this sit within the project finance learning journey? It is module-specific knowledge debt. First, let's put this in context. Let's say you own a solar farm worth $130 million. You've taken on debt of $100 million and you need to repay it. You could repay by fixed principal installments. If you have fixed principal payments, your interest payments will decrease over time. You could repay by a bullet-style repayment, making interest payments over time and a lump sum repayment at the end. Or you could repay by fixed debt service installments, otherwise known as credit foncier or mortgage-style repayments, or more commonly, annuity repayments. Now, as you may know, banks will typically ask that you repay installments on a quarterly or semi-annual basis. If you have a seasonal project like a solar farm, it's not going to be doing very well in the middle of winter. Enter sculpted repayments. This is where your repayment profile tracks your cash flow profile with a little bit of a buffer. How big is the buffer? Well, it could be double. The ratio of the two is called the debt service coverage ratio, or DSCR. So if it is double, the DSCR is 2 times. Or if there's only a little bit of headroom, the DSCR might be 1.3 times. So what determines the buffer then? Essentially, risk. Risk that the cash flows won't be what you forecast. Now, of course, these are different for different projects and different industries, and even different lenders. So the DSCR for a gold mine will be very different than the DSCR for a wind farm. Okay, so let's get back to our solar farm project. Where in the project are we? Here are the 3 main phases in an infrastructure project. We're assuming that we're in operations. But, in case you've been wondering, determining our principal repayment is all done before financial close. The intention of this is to lock in our debt repayment schedule based on our solar farm's forecast cash flows. What cash flows are we talking about? The ones that go to repay your debt. That's right, the cash flow available for debt service, or CFADs. And out of the CFADs, we pay our principal, our interest, and that is called our total debt service. So essentially, we're comparing these 2 line items. So just to recap, the DSCR is an input. It's used to calculate sculpted repayments, i.e. principal repayments, and we're using the rearranged DSCR equation to calculate principal. But remember, at this point, the project is not operational. So which CFADs and which interest are we using? We're doing this off the forecast CFADs and the forecast interest. Hence, the need for a model. Once the project is operational, this flips around and you're calculating your DSCR based off the debt service and the CFADs. The CFADs of which is the varying component. We call this section debt metrics. However, in this tutorial, we're not focusing on debt metrics. We're focusing on sculpting debt, i.e. sculpting principal repayments off the forecast CFADs. Let's look at how this is done in Excel. Take your CFADs, divide by your minimum DSCR, and this will give you your maximum debt service. What do we need to take off to get principal? Well, interest, of course. So that gives us our maximum principal. Why maximum? Well, remember the repayment has no connection yet with how much debt we've actually taken on. It's just telling us the maximum rate we can actually repay debt, based on the bank's sizing covenants. So let's link that into the account. The project can, of course, repay less debt if it needs to, by increasing the DSCR target. However, this is against the interest of equity providers because they want to maximize debt. And what gives us the max amount? Well, the minimum DSCR ratio. The last thing we need to do to finish this off is to constrain the principal repayment to the opening balance of the account so that it never repays more debt than has been drawn down. That's the minimum of the opening balance and the max repayment amount, so it will always take the lower of the two. One last thing. What is the significance here of this number? What does it mean? The total of the maximum principal repayments. What implication might it have for choosing how much debt to take on? We'll explore that in another module. If you want to learn more about debt in project finance, head to the Advanced Project Finance course to learn about debt sizing, debt metrics, and a host of other topics. It's our mission to simplify financial modeling. If you like this tutorial, you can share it with a friend or sign up to our newsletter. That's all for now, and see you on another tutorial.